All right. Good morning, everybody. We are the Monday before Thanksgiving, November the 20th. Good morning to everybody, and appreciate you all being here. Wasn't sure that we'd see many people today with kids home from school, and they get the whole week off. I mean, oh my God, a whole week off for Thanksgiving. What's the world come to? I remember looking forward to the 4-day weekend. But man, if I had a whole week off at Thanksgiving, I would have caused all kinds of trouble, I'm sure. So hopefully anybody with kids at home are keeping them busy and finding things for them to do. So, but we appreciate you continuing to take your time to be here with us on these Monday mornings. I had in trying to decide on which topic. I've got an array of topics that I always like to talk about, and I've got them, written down as to what am I going to talk about on each Monday. And it seems like as I get closer to a Monday, it's less like, you know what, those topics are great, but they can wait till later because here's something else that has come up more recently that is probably more important than some of these other topics. So today we're going to talk taxes. Because I actually spent this past several days on trying to prepare ours for year end to see where we're at, because it's really important to know where you're at, right? And I will say I'm not the best in like every month being on a regiment basis, making sure everything's inputted and everything. Everything gets inputted to our system automatically, but some things will automatically be placed in categories while others I have to go through and place them. And so that's what I've done is go through and place all these expenses into different categories so that they're properly placed. And it really got me thinking, because we've had a better year this year than the year before, and so it's kind of like, well, we've been making quarterly deposits to the IRS based on last year, and it's like okay, we've got to make for our fourth quarter, we've got to make a bigger deposit, because we don't want to wait until we file our tax return and say, oh, we owe this big amount, because that's when you get penalized as well. So, so I thought it was really important to talk about this today, and hope that everybody understands that, you're self-employed people. Okay. Hopefully you're running a business. And I talk about this all the time. There's a difference between being self-employed and being a business, but that's a talk for another time. Hopefully you are incorporated, but if not, you're sole proprietor and you're self-employed, and there are differences between the two. And again, that's a talk for another day, but we'll dive into it just a little bit in regards to taxes here. But we should all be making regular deposits to the IRS and not waiting till the end of the year to file our tax return and see, well, what's our tax bill. Unless you've had a light year, which I know some of us have in the past. I think the first year Valerie and I decided to go back into sales, we were like, yeah, we didn't do anything until we did our tax return. It was like, oh, we got to write a check. Actually, I don't think we wrote a check. I think we pretty much came out even. But we knew moving forward that as we started making money, we needed to start making quarterly deposits. And the way the IRS looks at it is, if your tax bill is more than $1,000 on April 15th, you should have been making quarterly deposits. So you need to see where you're at, right? And it's not too late to make a quarterly deposit for the fourth quarter, because that would be due on January the 15th, I believe.
16th, yeah.
Yeah. So each quarter, it's good to make a deposit. Now, I do remember the days where I actually had to, they required me going from quarterly deposits to monthly deposits. I had to make a monthly deposit every single month because my tax bill was too high. And I actually did a quick search, but I couldn't find out where that threshold is. There is a threshold that once you reach that certain point, then yeah, the quarterly deposits go away and you got to make that monthly deposit. So hopefully let's see, if you have employees, then you probably are aware, like Elliot, I'm not sure if you've got like employees on the payroll or not, but you probably face that monthly deposit, right?
Correct. You have a payroll company that
Yeah. Okay.
rolls it out monthly.
Yeah. So if you got a payroll at all, and now, I've used payroll services for myself in the past. So, and that was a part of making those monthly deposits. Actually, I would hire the payroll service and just send them a check every month, and then they would cut me a paycheck back, and then they would take care of my tax deposits and do all of that. So there was a nominal service fee to handle all this, but then I didn't have to do any of my reporting. I didn't have to worry about being on time because I was notoriously always late for my filings. And that's another reason to have something like that, because when you're late, the IRS doesn't care. They're gonna drop that penalty on you, and you're gonna have to pay them more money than you should. So, and that's the reason for bringing this up today, is that I never mind paying my fair share. I think we all need to pay our fair share to Uncle Sam, even though they don't know how to spend our money. We should be paying, because we do get a lot of services, and they take care of our roads, all this sort of stuff. But at the same time, I don't want to have to pay more than what I need to pay. All right. So I've learned over the years, by being self-employed, by having multiple businesses throughout my adult lifetime, I have attended so many seminars and webinars and spoken to so many CPAs, and to where I learned what I needed to do for me, right? So I can then go in at the end of the year and say, okay, here's my P&L, Mr. CPA, file my taxes for me. And they might question some things. I'm like, no, that is a legitimate expense for my business. Just as I've done with health insurance and things like that in the past. I knew what was acceptable and what works for me, and I can then drive that bus and direct the CPA, or if you go into Hewlett Packard or what's that other one there, whatever tax services you're using. So and Hewlett Packard, that's the computer company, it's the other one.
You mean TurboTax or?
No, the tax service. Anyway,
yeah.
It has a name like Hewlett Packard, but it's something different. But anyway, yeah. So you need to know what's right and what's best for you, and so take the time to learn. Okay, don't just say, okay, here's all my receipts, Mr. CPA, do my taxes for me, because there's a good chance they're going to miss stuff. Okay, because they're always going to err on the side of caution, and maybe they won't walk any gray areas. And there's a lot of gray areas. That's why these people with a lot of money pay minimal amount of taxes, because there's all kinds of ways to either defer that tax, or to just invest, put that money somewhere else where it's not being taxed, but you're getting benefits from it. So it's important for you to know that and understand that, right? So one of the ways to be able to benefit with your taxes is, instead of being a sole proprietor, is being a corporation, being an entity. Okay, and not only just being an entity like an LLC or a C corp, but taking that and creating an S corp. Okay, it's a subchapter S under the IRS ruling. So you file for corporate status with the state, and then you file for subchapter S with the IRS. And before I get into that, one caveat real quick is that as real estate agents, we can't just say, hey, I'm going to be Paul's Realty LLC. That doesn't work. You've got to be Paul Fidinich LLC, Paul Fidinich PA, whatever is on your license as your name. That's what you can be as an entity, and either as an LLC or a PA. All right, so that's really important to know and understand, because that falls under the licensing law. So if you go to an attorney and say, look, I want to form an LLC, hopefully you've got an attorney that knows real estate law and not just corporate law, because they'll be like, yeah, what do you want to call yourself? And they'll create an LLC with your whatever name you create, a fictitious name, but that wouldn't be correct in the eyes of licensing. So you want to make sure you do that correctly. But once you file for a subchapter S, here's the benefit to having that. So let's just say, I love round numbers because I don't do math in my head very well, even though I was always really good at math in school. I thought I was going to be a CPA. That was in 9th grade, and then there was other distractions, and then I couldn't see myself sitting behind a desk all day. So so what you want to do is as you start making money, and you know, some people will say, well, don't create an LLC or corporation until you start making money. My approach is, well, look, you're in business for yourself. Create the entity right away, because it's your business. So act like it's your business and you're in business, and create the entity, do all of that stuff before you get too busy. Because once you start making money and you start rolling, you just find that you don't have the time then to now start messing with starting your business from scratch all over again. So you always want to start early on. But if you haven't already, it's never too late to get started. And in fact, you have time this year, if you're not already an entity, that you can still become an entity by the end of 2023. And I believe you can still get some of those benefits for this calendar year. I forget how that floats backwards, but you would be an entity for 2023. So there would be some tax benefits there as well. But that's something you do want to check with your CPA on and confirm, because rolling backwards, I don't know the rule on that, but I do know there can still be some benefits for doing it this year. So the big benefit is, let's say you after you've itemized all your expenses and you've got a net income of $100,000. Well, with that net income of $100,000, you take $50,000 and pay yourself payroll, $50,000 to yourself, because you know what? That's still above the national average. So there's nothing wrong with saying, hey, yeah, I've earned $50,000 as payroll. And then you take $50,000 as a distribution from the corporation to yourself. You can look at it almost like profit sharing or something like that. Now, here's the difference. That first $50,000 that is payroll, you got to pay the payroll tax, the 15.3% that has the Medicare, the Social Security, and all that junk in there. Okay. Then your second $50,000, you don't pay that 15.3%. You only pay the income tax portion, as you know, as you calculate up what your income tax is. That would apply towards that portion of it. So you save that 15.3% on that secondary $15,000. So that's like $7,500, just over $7,500 that you save in taxes. Does that make sense? I mean, did I explain that in a way that makes sense? Because I think I'm confusing the hell out of myself, but that's what taxes do.
No, it makes sense.
Is that with an S corp, Paul?
That's with an S corp. You want to be an S corp.
An LLC with a side of S corp.
Yeah. So
Yeah,
in recent years, they've made it where if you're an LLC, you can become an S corp. It didn't used to be that way. You used to have to be a C corp that then registered as a subchapter S, S corp, but now you can do it as an LLC, and I believe as a PA as well. So
Yes,
so
you
yeah,
can
so that's
as a
what you definitely want to look into that, right? And it's actually it's something that is easy and simple to do for yourself. You know, you might require a little bit of time, but if you have the time, there's services out there. I think, for $100 you can get it done. But again, you probably would have to drive them and direct them on, look, the name has to be this way. And you've got to be the one to make sure they know what it is that you need, because they just, they're probably all automated. And it's just like, yeah, just fill out this form, boom, and you're done. And they'll get everything filed for you. So it is pretty inexpensive to do this through a service. It's really inexpensive to do it on your own. But you can also pay, probably just a few $100 to a good real estate attorney that knows the ins and outs, so that you can make sure that it's done right as well.
I would also encourage you to work with an accountant to get this done, because there are special forms and extra forms that have to go in to make sure it's done properly.
Yeah. So you want to make sure that the people you're working with, the people on your team, okay, also have your best interest in mind, because you're going to go to an attorney or maybe a CPA, and they're going to be like, well, why do you want to do this? Why do you want the extra paperwork? It's not worth it. Oh, don't do it until you start making a lot of money. Okay. Those are not the people you want to work with. Okay. You should be doing this because your intent is to build your business and to make a lot of money. So if you don't do it with that intention, then
And keep a lot of money.
and keep a lot of money. Exactly. Yeah. You want to keep as much money as you can, because, that's how you keep rolling that forward, reinvesting in your business and in yourself, so that you can continue to grow. Because if you're not growing, you're dying. So you have to continually grow each and every year in whatever way that you can. And to do that, and that's how these big businesses do it, right? They're taking that money and reinvesting it. And that way they're not paying Uncle Sam on the income that they've made, right? All those profits, they've rolled those profits into other investments into their business, so that they can continue to grow and make even more money. And so that's what you should be doing that as well. So if you're not an entity, I can't tell you to do it or not to do it, but I've owned so many businesses over the years. Every single business I did, the first thing I did was form an entity and worked at it that way. Ellie, you got something?
So I'm a PA, and they required me for real estate to have my full name, just like it is on driver's license. Well, my CPA files me as an S corp.
Mhm.
And the first time I did it, compared to the prior year, it saved me like 17 grand.
Yeah. That's the idea. This is one of those benefits that we as the little people get from the government. And so it just astonishes me how people are not aware of this, and they're not taking advantage of it. So yeah, Kevin?
Is there a level where it wouldn't work to go as an S corp and just stay as an LLC?
Well, yeah. So if you're a lower income and you're not making a lot of money, I mean, the benefit, maybe it wouldn't be worth saving a few $1,000s to you to go the S corp. It doesn't cost you any more to go S corp if you're already an LLC. So why not do the filing and get that added benefit, because you won't get that benefit as a LLC.
You basically got to project your income for the year. And as a independent contractor, with my income is this. I'm still new and still cutting my teeth. And I've looked into it, and my accountant, she's educated me on it. In fact, during COVID is when I set up my LLC, because there was no showing of homes. So I got all those teeth cut already. But I have considered going an S corp once I get to a certain level, and maybe I'm more of a referral business, or I'm generating a referral business as well. But in the meantime, it's this way,
Mm-hmm.
And I can't draw a salary just yet,
Well, and you don't have to draw a salary. That's
Unless you want to buy a house.
Well, unless you want to buy a house. Yeah, there you go. A salary helps then. But still, look, if you have 2 good tax returns for the past 2 years showing good income, I mean, we're not paying ourselves a salary. The money comes in, we take out and pay what we need, and it just keeps piling in the one account, and then we'll distribute at the end of the year, right? So but once you get more consistent, having a payroll certainly is good, and will be more beneficial to you when you go to buy a house. But look, if you're going to buy a house, I think Brian just wants to look at your tax records, and he knows you're self-employed. So how you paid yourself, that I don't think is going to matter. Brian, you want to chime in on that?
So if anybody's self-employed, good morning, everybody. Sorry I'm late. If anybody's self-employed, we jump directly into the 21 and 22 returns. Some people still have not filed their 22 returns. Someone will be asking for an extension, but that was actually only good until October. So you're right. I mean, we go directly into the returns, and typically the last 2 years. There's some loopholes and other things to get to where it's just 1 year, or if your tax returns look really bad, then we don't look at them at all. We look at your bank statements. But generally, yeah, we start with 2 tax returns and go from there. 2 years tax returns.
Okay. Yeah. So the payroll part, look, I remember at one point when I did do that, I paid a payroll service every 2 weeks. I was getting a check, and so yes, it made it a lot easier if I wanted to go borrow money or do certain things. But what it did, it just made my life easier when I can do that, right? And my income wasn't steady. I was up and down. But what happened was that I built up enough reserve to where each month I put a certain amount to them, right? And I didn't pay myself a lot. I paid myself what the average salary was for real estate. And then the money kept accruing in my business account. And then I would draw that out at the end, or take bits and pieces throughout the year that I needed. And then that was my distribution. Okay. So that would fall under that distribution half against the payroll half. So, and then Bridget, you had a question about if you have money left at the end of the year, should you take a draw at the end of the year? So, well, not necessarily. I mean, if you have money in your account at the end of the year, it all depends on how you allocated that money. How did you assign it in your P&L? Is it assigned? Is that just if that's your net profit? Then if you're an entity, you might want to take a look at, well, do I use this as a distribution or not? And that is a conversation for your CPA without a doubt. But if this is like net profit and you're paying taxes on it, having it sit there, that's your working capital moving forward, right? So that's going to be all taxed in 2023. So even though that's sitting in your account in 2024, that's part of your working capital that you can spend to reinvest in your business. Now, you won't get a tax benefit for 23 for reinvesting it in your business in 24. But again, there are ways to be able to shelter that money to defer the 2023 taxes. And that's something you should ask your CPA on as well, as to, okay, so and this is the time to start looking at that, right? Because you have a little bit more than a month to do some planning and strategizing how you're going to close out the year. Ellie? Or
you can put it in a SEP IRA too, instead of just having it sit there and not accumulate anything.
Right. So yeah, so that is definitely a great way to defer your taxes, right? So we should all be putting into a SEP IRA, a 401k, or any investment like that to save for retirement. However, you have to consider, because once you do that, right, you can't then take that and put that back into your business to do marketing and so forth next year. So, but you definitely should take a piece of that and put it away if you haven't already throughout the year. And you got to figure out what is the maximum that you can deposit for yourself. And I would do that. There were a number of years where I didn't make any deposits throughout the year. And I'm like, okay, I'm looking at where I'm at the end of the year. And I'm like, yeah, I'm going to get hit from Uncle Sam. So I'm going to go ahead and take, the maximum amount that I can deposit, go put it into my, at the time, 401k. And that way now I'm pushing that tax payment out to retirement, because hopefully then I'll be at a different tax bracket because I'll be retired and the income level will be a lot less. So there are a number of ways to be able to defer that payment to Uncle Sam. So something else that you need to look at too is, this is open enrollment time. So for your health insurance, if you're on the healthcare.gov plan, you got to figure out where you're at now versus, where you think you're going to be for next year. So you have to somewhat project, and it's not always easy to project where your income is going to be. But you've got to kind of use your past year and figure out, what's your tax bill going to be? Because if you made more money this year than last year and you were on the healthcare.gov plan, then you're going to be owing some money back, for reimbursement because they've given you too much of a credit. So that's something else you need to look at if you are on their subsidies. And there are some charts online that you can dig up that will tell you, if you're what percentage above the poverty line you are. That will dictate what percentage you actually have to give back. And there is a cap on what you have to reimburse. I think there's a cap of a couple $1,000s. So it's not real bad, but that is another way to be able to save some money and help yourself. So let's talk about some things that you can deduct. Now, I don't know how many of you are using the home office deduction. Look, and this is becoming even more and more popular. It used to be that, don't use the home office deduction because that's a red flag. Well, that was many years ago. And they say that it never really was a red flag. But today, a home office is so much more readily accepted because, especially since COVID, so many people are working from home. However, different professions will have different reasons for that being a red flag. Okay, because if you were working in a corporate situation and all of a sudden because of COVID everybody's worked from home, it could be a little bit more challenging to take a home office deduction, because you have to make sure that whatever area you're claiming is 100% business. So you can't do personal things in your home office. You can't have personal belongings in there. You can't have your desk here and then your playpen over here with the kids and all the kids' toys and everything, in there with you. It's got to be 100% for business. In real estate, it's a lot easier for us to be able to justify that. I mean, you look at my office here, I got a few personal things in here, but you look at here, this room is used for office. Now, what I do is I take the square footage of this room and I divide it into the square footage of the house. I get a percentage. So let's just say this is 10% of my house. I can deduct 10% of all the expenses of operating this house for the electric, the gas, the water, the mortgage, property taxes, all of that stuff would be 10% of that would be applied towards my home office expense. So it is a good way for you to be able to claim a reasonable expense, okay, that's going to help offset your taxes. There's a caveat to that too. You have to make sure that you understand what the repercussions is with your CPA, because that does, when you go to sell your house later on, it's kind of like depreciation, where there's going to be some sort of recoup in that or something. I don't fully understand that particular part of that, other than that might be minimal compared to what the benefit is of taking that deduction. So you want to look into that. But I think home office is definitely a good deduction to have, especially when you're looking for deductions. All your office supplies, your printers, your toner and your printer ink and all that sort of stuff is all part of your expenses. And you know, the list can go on and on. The way I look at it is, you know what, if it's something that you use for business, then that is a tax deduction. So you do have to be careful, okay, because you have to look at each item. If you know, I'm trying to think of a good example here. I can't think of anything off the top of my head because it's just like, I'm more of that, yeah, I use it for business, so it's a business expense. So you just need to track everything, right? Now, I've talked about it many times before, but I'm using the app Hurdler. Okay, Hurdler is a free app that we get through Stellar MLS. I don't know what it would cost on the open market, so I don't know, Brian, if you use something already, since you're not, you know, a member of the MLS, but Hurdler is an app. It's HURDLR. There's no E in it, and I can go on my laptop or I can go on my phone. And I love this because it's really convenient. Like, I just set a bunch of rules. I said, okay, every time you see this expense, boom, drop it into this bucket. And it said, do you want to go back to all the old ones? I said, yes. So now it'll go back and find all the old ones and drop them all in the same bucket. And then moving forward, when that charge comes in on one of my credit cards or my bank statement, it's going to recognize it and go, okay, this is this expense, and it's going to drop it in the bucket for me. So your first year is kind of like training it, setting it all up. And it's the same thing with mileage. I go on my phone. I get alerts when we drive somewhere. It's like alerts, oh, you just drove 7 miles. And then I can go on there, swipe either personal, or I can swipe it to business, and then I can assign it. I can assign it to a particular customer. I can assign it to a listing, or I can assign it to some other category if I want. Or I can just say, you know, no buyer, no listing, and it's just business mileage. And that way it keeps an exact record. Okay, you should be keeping track of your mileage. Now, this is another big thing. Your mileage. Do you want to deduct your mileage, or do you want to deduct your actual expenses on your car? Now, I have learned that in most cases, if you want to track everything with your as far as expenses on your car, in most cases, you're going to come out better if you do that with your car than if you track the miles. Because the way the IRS calculated the miles, they used something like a Ford Focus as far as calculating expenses, and that's how they came up with the cost per mile. And I can tell you that, yeah, it probably cost me a lot more than that whatever they reimburse per mileage is. But if you go the other way and you want to just have all of your expenses itemized out, you also depreciate your car. Okay, so that depreciation gives you a big deduction as well. But then when you go to sell your car and buy a new car, then you're going to get taxed on that because you've depreciated. So now if you've depreciated your car down to here, but you traded in and you got here, you got a gap there that they're going to say, okay, you owe us a tax on that gap. So I'm, as much as I want to capitalize and get everything back that I can, I do know that I like to keep things simple. I use the mileage basis and I track it with the app. Because if you go the other route, you can't convert back. You can't say, well, this year I'll do the depreciation and do all the expenses, and then next year it's like, well, you know, maybe that didn't work out for me so great, so I'm going to switch back. No, for as long as you own that car, now you have to maintain those records and use that type of deduction. Does that make sense? So, but whatever you're doing with your car, you want to track all of that, because that is another big deduction that you want to capitalize on and maximize as you're expensing everything. Because we in real estate, we put on a lot of miles. And without our car, we're really hosed. We're out of business if we don't have a good working car and tracking all of those expenses. So you want to definitely use that. So any kind of transportation that you're using. How about trips, conferences, things like that? Anybody take advantage of those type benefits? Yeah, Ellie. Yeah. Kevin, Brian, I see you nodding. Yeah, absolutely. I've been to many conferences, and it's a great way to get an expense. You're going, you're getting some great education and doing some great networking, and maybe take a few extra days because you can. I think it's for every 4 hours that you attend something, you can take a day to yourself. So if you go and you got an 8-hour day at the conference, you can take the day before, take the day after, and make it a 3-day trip, and you've got all of that has been a deduction. So so there's different things that you can do with that. Maybe you want to take your corporation and all its officers onto a trip and do business planning for the year and kind of talk business but just do it remotely. Well, that could be a business expense as well. So there's different ways to do that, and there are things to look out for and things to do. But I mean that is a great way to be able to get some deductions while still enjoying the money that you've earned. So you want to learn more about that if that's something you want to take advantage of. And again, these webinars come up all the time. You want to jump on these and just learn what you can. Okay, you'll get from the free webinars, you'll get little tidbits here and there, so that you don't have to pay a fortune to be able to learn all this stuff. All your education, if you're doing any kind of education things, your legal and professional fees, things like that, those are all deductions. So you really want to make sure that you keep things organized, because God forbid you get audited. It's okay if you get audited, and yeah, they might find something, maybe they don't. But the more organized you keep your records, if they audit you and they see that and something comes up that's questionable, it's less likely that there's going to be some sort of big penalty that comes with it. So keep yourself organized and keep good records. Keep all the good records that you can. Review your estimated tax payments. If you keep in good records of your income and your expenses, you should do that on a monthly basis. And I'll be the first to admit I don't do it on a monthly basis, but you should look at it every month and see what you're spending, what kind of income you got coming in. And I know that sometimes when you're still young in the business, that you look at it and it can be a little depressing sometimes, because man, I'm just not making the money yet. But don't worry, you got to know those numbers, right? And keep looking at it as you go forward, because that will start to build up, especially if you pay attention to it and you use that as a driving factor to motivate you to do what you need to do to grow that P&L. So you can always consider to defer the income, find ways to defer the income. If you have a good year, a year that's much better than the year before, find a way to defer that, whether SEP IRA, 401k. We have a HSA account, and we just made we maxed out our HSA account, even just to, put a deposit in there, because that's pre-tax money that we can use for medical reasons. And it's like, once I get onto Medicare, I can't deposit to an HSA anymore. So then that's next year, believe it or not. So I'm like, yeah, I want to maximize that deduction now, right? So that just because when I'm on Medicare, I can't deposit in, doesn't mean I can't use that towards medical expenses and prescriptions and all that sort of stuff. So, get with professionals now to start thinking and planning for your retirement later. And I know for some of you, that's a long way off. But trust me, it gets here faster than you know. All right. And so you want to do things to prepare yourself now, so that when the time comes, you can actually enjoy retirement. And the nice thing about real estate is that we don't have to stop working, because while it's a demanding business, once we get to that retirement age and we have other supplemental income, it could be like, you know what? Yeah, I can just pick and choose who I want to work with and who I don't want to work with, and just work as much or as little as you want, right? So you still stay in the business, you still get some income, you still get some tax benefits by having that, and yet you get to choose. So some of those days that you have to work with somebody, you can choose, no, I don't have to work with them. I choose not to. So yeah, so that, you know, but that requires planning ahead of time. So, you know, that look, we've just been learning about retirement ourselves here recently, and we're like, oh my God, there's so much to this that we weren't aware of. And you know, with a little bit more planning, you know, things could have even been a lot brighter, but that's okay. You know, we're learning now, and we're going to maximize everything. We're going to do everything we can moving forward to be able to maximize our income. Because I thought about, you know, taking Social Security early, right? Well, I learned that if I take Social Security early and I'm still making money, I'm going to lose a lot of the Social Security benefit. So it's like, well, I'm going to wait till I get the full benefit, which is like 66 and 10 months for me. So just a few more years. And then that will be my supplemental income. It'll still count as income. So my real estate income will, you know, it's still going to be there. But at the same time, I won't get penalized. It'll just be having to pay the income tax part. So,
yeah, and I might add that everything's confusing. Social Security is confusing. Medicare is confusing. I mean, there's part A, B, C, D. And, you know, just briefly, my parents have been collecting Social Security for decades, and they've been getting less than they should have, and it's all set up incorrectly. So I've got to drag them in and fix it in their mid 80s. So just
yeah, and there's
pay
no
attention when you get there. That's all I have to say.
Yeah, there's no collecting what was due. It's like, oh well, sorry, you missed out, and you know, we'll correct it now moving forward. But all that you lost out on is lost. So that's why I say it's always, you have to learn what's best for you. Okay, take care of yourself first. All right. Yes, listen to good CPAs, listen to good attorneys, but take that advice, roll it in here. And when you hear somebody else tell you something that's conflicting, which you will hear conflicting stories between CPAs and attorneys, you need to kind of make heads or tails out of that and do your homework and figure out, okay, for me, based on my situation, how is this going to work? And that's how you have to be that driving factor, right? Because only you know what's best for you. Your CPA, your attorney, they don't know what's best for you. They just know what's best according to the book. And that's just how I like to put it. It's by the book, right? Because that's what they know. And they're dealing with hundreds of people, okay? And those are all going to be individual situations that are all going to be unique and different from yours. Now, maybe they'll have some other input based on that can help you. So you don't want to not speak to them, but you want to find out what's best for you. And you do this by you go to different webinars, different seminars, and hear these different approaches by people in the industry, because you will get different stories. You will get conflicting stories. But you will get great tidbits of advice that you can go back and say, oh, you know what? He said that I can do this. So let me dig a little bit deeper into this and see if it is something that makes sense for me. If it is legitimate for me, that might be something I need to apply to my business. Does that make sense? So we're at the year end. And this is the time to really take a look at where you're at for the year. Start doing your year-end prep. If you haven't done your business planning for 2024, start to sit down and work out your business plan. But look, the fourth quarter, I've seen so many people just kind of kick back on the fourth quarter and say, well, it's the holidays, nobody's doing this, nobody's doing that. And then they don't really do a whole lot of anything. The fourth quarter is preparing for the first quarter. So doing all the things necessary, just as we talked about, getting prepared, making those phone calls, hold yourself accountable to those goals you set for making those maniacal calls, as we've talked about the last 2 weeks, right? But it's also year end. You've got to start wrapping up your year, right? So you've got to reflect back and look at all that you've done this year. Make sure your record keeping is good. Make sure your accounting is good, and then figure out, well, I have what, 6 weeks left of the year. So what do I need to do differently to help protect some of my income and not get hit with this big tax bill? And if I do owe a big tax bill, how do I not get penalized? Because it's like, oh my God, yeah, I had a good year, and now I've got this big tax bill. And if I wait till April 15th to file and then make payment, then there could be a penalty that comes along with it. So the money is due now. The tax return is due later. And then if there's differences, that's when it's made up at that time. So, so you want to take a quick, easy look at that and do a rough calculation and make sure that you've at least got it covered. So I think that was the points that I wanted to cover today. I know it was a lot. Hopefully there was a lot of good information on there that you hadn't thought about, Kevin.
Yeah, Paul, thank you very much for bringing this topic up at this time of the year. Sometimes we forget about taxes until the quarters come around or the end of the year comes around. I don't think it's ever too late to do your tax planning, your retirement planning, and your estate planning. Everybody's situation is different, and I think it's one way to tell your family that you love them if you've got these plans in place. Whether you're single, married, whatever your situation is, we work so hard, and to let this money go, of course we pay our fair share in taxes, but to make sure that, the end of your life, the end of your time is directed the way you want to direct it. So thank you very much for prompting us and sharing this information with us.
Thanks, Kevin. Yeah, that's some good points there too, is directing the end of your life, right? And look, it's unfortunate that we have to wait till retirement to where we can maybe start enjoying more free time, because we do work a lot through our adult lives, and in some cases we have to. In some cases, for me, I mean, I wasn't that way, but having been a business owner most of my adult life, it drove me to always be working. And while I enjoyed what I did, and I did, I worked hard and I played hard. I've got, numerous vacations and numerous good times and great memories and things of that. But I do know that I continue to work hard. Here I am in my 60s. As a kid, I thought I would have been long retired before now, and just, feet up on the beach, drinking a cold beer and not worrying about anything. But
60s are the new 40s.
60s are the new 40s. Yeah. So, but look, I've also adapted to the fact that I don't ever want to stop working, because I feel like if I stop working, then I'm just waiting to die. I want to continue to stay active, but I want to have more free time to be able to go and enjoy more things, right? Do more travel, have more time to myself. Like right now, there's a number of things I can hire people to come do around the house, but I'm like, man, I'm capable. I want to do that stuff myself, but I look forward to having that time to do the piddling around the house that I want to do, and not have to hire somebody else to come do it and things like that. But I chose real estate. Actually, I think real estate chose me, but I knew back in the 30s when I was an electrical contractor, I was like, man, there's no way I can do this in my 60s, because I knew my body was already getting beaten up physically. And after I spent 23 years as an electrical contractor, and so I knew when I entered real estate, I'm like, oh man, I can do this easily into my 70s. I mean, that's not a problem at all. So that's one of the things why I do this, and also have chosen, being a trainer, because again, I can do this throughout my 70s where it's not going to be so physically demanding, right? It's mentally demanding, but that's all right. I think the more mentally demanding things are, the more mentally stable you are, and you don't lose your mind, right? So I can do other things physically to keep fit and help myself, my body last longer, right? I hope to be, my goal was always to hit triple digits. I hope to do that with all my faculties in place. Might be able to get along on my own physically and have the mental capacity still. And that requires really taking care of myself. But if I was still an electrical contractor, I know my body would be beat up terribly. So, all right, who else got something to want to add? All right, well,
one last thing I could say, I suggest to a lot of my investors is 1031 exchange.
yeah, so 1031 exchange, if you're not familiar with it, hop into a 1031 exchange class, because you want to be familiar enough so that when you're working with an investor, or just, it could be, it doesn't have to be labeled as an investor, just somebody that's got a vacation property. They own a primary somewhere else, they own a vacation property here, they can still roll that investment property into some other property using a 1031 exchange and defer their tax payment, okay, on the gains that they have on the sale of that property. So a lot of people right now that are selling are going to have a lot of gains on their property, right? So now you can't do a 1031 exchange on your primary, but your primary gives you $250,000 for a single person, up to $500,000 for a married couple in tax-free gains. But as an investor, you don't get that same rule. So any gains that you got the capital gains. But if you roll that forward, that gives you more money to work with on your next investment. So you're deferring that tax bill. All right. Anybody else? We're quickly approaching the top of the hour. I did want to let everybody know that next week we will not be here. I thought about doing this while we were on the road. We're going to be driving to Miami Monday morning, and I thought, well, I can let Valerie drive and I'll do the meeting, but I think we're going to skip next week. But we'll be back the following week, December the 4th. And we'll continue on. We'll get 2 or 3 weeks in December before we break for Christmas and New Year's. But we're gonna keep this rolling forward in 2024. Got a lot of good stuff in the works. A lot of good things that'll be coming out. Happy Thanksgiving, everybody. Thanks, Valerie, for the reminder, because I keep forgetting that. But and today is Pie Day for us. We're going from here over to the new Costco in Claremont, and going to pick up pies and distributing them today and tomorrow. We have a lot less pies than we've given out in years past, only because we're driving all over town. We just don't have enough time to deliver as many pies as we would have liked to. So but we're going to get pumpkin pies and deliver them. So that's something that has become a yearly tradition for us. So you might be something you want to consider for yourself. It's a great thing. People really appreciate it when you show up with a pie. Not that costly. When you get them from Costco, they're huge, and people remember it. Every time I go to the dentist, they're like, "Oh my God, we love when you bring us the pies." And so it's like, oh, I guess we got to include them this year too. So so anyway, I can go on and on about this, but anybody have any last minute words for the good of the cause before we depart?
Happy Thanksgiving, everyone.
All right. Well, thanks you all for being here. I appreciate you all. Have a happy Thanksgiving, and I look forward to seeing you in 2 weeks. All right, take care.
Guys. Bye.